Okay, you're all set.
Good to go?
Yep.
All right, it is 6:32 p.m. I'd like to call this meeting of the Employee Insurance and Pension Benefits to order. Do you want to do a roll call first, Jen?
Sure. Dave Johnson.
Here.
Anthony Kolowski. Matthew Kolowski. Bill Lakota.
Here.
John Slazarski.
Here.
Jay Crussell. AJ.
Yeah, I'm here.
Yeah, I want to tell that. I always messed up. Tim Mankey.
Here.
Sam Sharma. And Tony Millie. All right, you have a quorum. You have 5.
All right, wonderful. All right, let's start with public participation. If there's anyone in the room or on Zoom, which I don't think there is. Well, it looks
No, I don't have anything there.
okay. All right, we can move on to new business. Looks like we have 2 presentations before us today. So it looks like our representative from Lockton's are first up.
Okay, excellent. Can everybody hear me?
Yes, Lisa, we can hear you.
Thanks, Janet. I
No
am going
problem.
to try to share my screen, which is always other screens. This will
Let me
stop
know. I
others.
might have to give you permission. So,
It says this will stop other screen sharing. Do you want to continue? I'm going to put yes.
yes.
Excellent. Excellent. And then let's see if this works and share. Okay. And on the phone with me as well. So this is Lisa Daly again. And then on the phone with me is Tori and Dave McCluskey. They're under as Lisa Daly as well. So we're just going to continue the game of 3 Lisa Dalys for you this evening. And Tori is going to be the main presenter. I'm going to try to click when she wants me to click through the presentation. Please stop her when you have questions. Make it comfortable so this can be more of a conversation. So Tori, if you are ready, I will click to the next slide.
I am. Thank you, Lisa. So as Lisa said, I'll be reviewing an overview of a few different items here. You can go to the next page, Lisa. So our agenda for today is first
let me go back.
over our policy year-to-date medical claim detail. So that would mean claims from July of 2024 through our most recent month of data, which is currently July 2023 through April 2024. There we go. The second item we'll be reviewing is our finalized budget for the upcoming plan year for the 24 to 25 plan year. And then we'll wrap up the conversation just reviewing in detail the stop loss renewal since it is such a big piece of our budget. So you can go to the next page, Lisa. As I mentioned, the first thing we'll be reviewing here is our claim experience for the medical plan year to date. I'm sorry, is there a question? No? Okay. So here is our current policy. The top graph actually shows a little bit of historical data here. So what I can take away from this top graph is that claims are continuing to increase as we move through April 2024. So you can see how that red 12-month average is trending upwards as we move through our most recent month. I did point out in that little squared off blurb there in the top right-hand corner, we do expect claims to increase through the end of our policy year due to seasonality, just the way the deductibles are set. And that is following this trend, but we are seeing a more significant increase in our last quarter of claims, that Q3 and into Q4, than I would hope to see. We can see that really coming into play here on that bottom graph. So here we have our current policy listed out by month. We can see the total cost, which is our claims and fixed cost. And then layered underneath that is our accrual or our budget line. So we can see for that first really half of our plan year through December, claims were slightly above, but really generally right around that accrual or budget level. As we move into that quarter, the end of Q3 and into Q4, claims are really skyrocketing a bit up into the 2,000 PEPM level. Just another reminder there, PEPM is per employee per month. We break the costs into that granular level to account for any headcount changes that there are. Not a significant problem here for Newington, but just to make sure everything is looked at on the apples to apples basis. So we are seeing, again, that increase in the later half of our plan year. really happening in January 2024. So you can move on to the next page, Lisa, here. This is a little bit more detail into our experience year to date. So as we can see, we're looking at a deficit across both the town and Board of Education, and that of course leads into the overall total group being in a deficit this year. So starting with the town, we're running at a deficit slightly above $100,000. The gross loss ratio, so again, your total cost compared to your budget, is running at a 105.5%. Once we back out your claims over their stop loss level, that loss ratio becomes 103.7. So our target being 100%, you're about a little bit less than 4% above our budget, which brings us to that deficit about $100,000. This year, which is slightly new for the town, we don't see much high claimant activity for the town portion since it is a smaller group size. But currently in our current policy year, we have 2 high claimants that have reached that 175 ISL level. So that means receiving about $51,000 in reimbursements for that group. Again, that is inconsistent with the historical experience. We don't usually see much high claimant activity from the town group. As I mentioned, this is a smaller group size, so this only accounts for 26.4% of the entire population. What that means to me is with a smaller group size, we do see claims being more volatile. So if you are hit with a high claimant, as we were this year with hitting with 2 high claimants, we're seeing that impact a little bit more in our budget. So claims in March of 2024 were extremely high for the town. If I pull that up on my side, that amount for the town was 100, that loss ratio was 170. So that was really the biggest driver for the town, was the month of March of 2024. If we were to remove that or normalize that month, you guys would be, right around the 100%, slightly below your budget actually. So the March 2024 claims are really driving the overall deficit here year to date so far. I'll move on to the BOE now. Similar.
I've got like 2 questions. If you just can hold on 1 second.
Yeah, absolutely.
Just since you're over budget, what loss ratio is projected when you do set the rates? Are you projecting at 100 or like 95 or 90?
We always project for the 100%. So really the right in the middle. We want to target 100% exactly. So if we do want to target a slightly less percentage than that, we can build in some margin. We do not have that built into our projections this year. So again, we're targeting that 100% for the upcoming plan year.
All right, thanks. And
yeah, to put it into context,
Change healthcare fiasco have anything to do with the heavy March, or did that not really impact this?
So that is hard to tell, to be honest with you. We did see on some end a very slight suppression to claims in February, really. That suppression may have been kind of brought over to March. So anything that was suppressed in February may have been reported in March, which may have driven those claim months up for that month. But the 170 is still an outlier. And I would say that full impact is not from Change Health. Direction from our actuarial team is, there was not a significant enough change in claims for us to make any adjustments for that. So it's hard to tell exactly if it was a Change Health, but I would say because it's so high, it's more than just the Change Health. If there's any impact from that, it would not be simply chalked up to that.
Thanks.
And I will actually just point out, I just pulled up the cost report in detail on my side. And February claims were also high with a loss ratio of 127. So I would probably rule out the Change Health being any impact on the town's high claims through Q3 and Q4.
Any GLP-1 impact?
Dave, do you have an answer for that?
I'm sure there is. I don't know what it was. We're seeing that across the board, but I don't have the utilization report.
This plan does have like prior authorization policies in place for that, right? Like it's only used for diabetes, or is it it. Do you know what controls are in place, if any?
We can follow up with that. I know that we had a report run. Jenna, who's not on the call right now, that's part of the team, ran a report to look at the town and board and to see if there was any GLP prior authorizations for weight loss versus diabetic diagnosis. So we can follow up with that.
I can tell you, Bill, that we're a small group.
Mhm.
So we know we've had 3 to 4 people out on FMLA this year, which is pretty high for us. We don't usually, if you have 1 in a year, that's a lot. But we've had 3 to 4 people.
Oh, I
out.
definitely agree with the small group size definitely has a volatility
Yeah,
in claims.
and with that many
Someone's hard to
people,
protect
it
against. That's why you have the
just-
stop loss. Yeah.
It just seems every other day somebody was going out for something.
But I just, the GLP-1s in particular they're at this, both instances, they're gonna be miracle drugs
Mm.
down the road as their costs come down. But right now, the horse kind of left the barn before entities put controls in place where if you only want to use it for diabetes, if you go to use it for weight loss, I mean, that's like $13,000 a year per person that uses it. So that can be significant. And then, you know, just the Change Healthcare was kind of nominal and they did recover pretty quickly from that. That put a real dent in things in February. I don't know if anybody been watching that, but that was a pretty fascinating ransomware attack.
Agreed. So
If
we'll
every-
follow up with you on the GLP-1 utilization. If we have any significant cost impacts, I'll definitely make sure to call that out for you guys so we can see how that's impacting the current year. And then, like I said, Lisa and Jenna will follow up with the pre-authorization information. Great questions though, because those are big hot topics right now with our actuarial team. So we're definitely discussing those regularly with them to make sure that we're accounting for any claim impacts that they have. But at this time, I would say we can rule both of them out for now. We'll follow up with the GLP-1s if we can find some more information in your data. Of
Thanks.
course.
Can
Okay,
any
so
of
now-
you speak? I have a question. David Johnson here. Can any of you speak to the inflationary impact on these claims costs we're seeing here and the deficit on the loss ratios?
So we are seeing the impact of inflation in our projections. I am accounting for that in my projections. Every year we increase our trends accordingly. That is provided directly from our locked-in specific actuarial team. So they factor in a bunch of different pieces, one of those being inflation, and they pull in a few different trend surveys from, you know, the Siegel surveys and Kaiser surveys and those types of things. So we do an all-encompassing look at that, and the actuarial team provides us guidance each year. This year they did increase those percentages by 1 full point, and then the RX trend had a slightly more significant increase to that. So and that's for the GLP-1s, but we are accounting for that with our trend. It's not really looked at right now in the claims data, but when we look at the projections in a few minutes, you'll see that my trend is up a bit from last year to account for that inflation.
Okay. 1 point doesn't seem adequate, but I'll wait to see what your projections are.
Yeah, so trend is it's an interesting topic when it comes to projections. So 1 point may not seem like a lot, but we do trend that forward to account for, you know, the months that we don't have of experience today. So while we may trend, I believe we use 7.5%, the effective trend that's actually applied to the projection is a few points higher than that. So it does work its way out, you know, as we have the projection, but I'm more than happy to discuss with you guys in the future years what we want to use for trend assumptions to make sure it accounts for everything that you guys feel that it should.
I'm trying to reshare, but having difficulty. I'm not quite sure if you saw. I'm trying not to leave the webinar. Do you want to
Want me to
try
get
and,
that?
yeah, because I only can have a small picture of you right now. I'm not quite sure what happened.
Let's see this one. I'm a few pages ahead of myself now. Sorry.
There you go. And you're on the Board of Ed piece.
Perfect. All right, we're all set to move forward to the Board of Ed, or any more questions I can answer before we move on? Okay, I think that's a good sign. All right, so the Board of Education, like I said, this is a similar story to the town, a little bit more severe though. So the deficit here is just under $775,000 for the year. That gross loss ratio is 116.5%. When we take out the claims over that stop loss level, that comes down to a net loss ratio of 109.1. So again, the target being 100, we're about 9 points higher than budget right now through April 2024. Now, this group did have 3 high claimants above 175. They were much more severe in claimants, so the reimbursements you received for these 3 was $630,000. So again, much more severe high claimants than we saw for the town, and that's why we see that gross and net loss ratio changing so much once we net out those reimbursements. This group does have 73.6% of the population, so it does make up a much larger portion of the total. And then the last point that I wanted to say here is total costs have run higher than accrual every single month except for July 2023. Now, that first month of the policy is generally suppressed because of those deductibles being reset. So this plan is running very hot in our current policy, and we definitely want to account for that with the projected increase for next year.
Do you have any information on high cost claimants? Have they resolved themselves? Or were these tragic accidents or like a chronic condition that's going to be ongoing through even the next projection?
We do have that in our cost report, which I do not have pulled up right now to show you. And off the top of my head, I'm sorry, I don't know that off the top of my head, but that's something that I can also follow up with you guys on to show some clarity in the high claimants.
At the BOE side, I know one of them passed away.
Okay, that's helpful. Okay, so I'll follow up with that because, like I said, I'm not sure off the top of my head, but I know that it is in our cost report that I produce monthly. So we do have our finger on the trigger for there, but it's just not included in this presentation, unfortunately.
I pulled it up on our side.
Thanks, Dave.
Highest one was eating disorders. There was something that it's listed as aftercare, which basically means it's significant hospitalization. Heart disease. That's not ongoing. The main one that's ongoing, and there's one about $150,000, which is diverticulitis. I believe it's Crohn's disease. We've seen that person for a while. But you had several cancers and several heart disease problems.
Thank you for that, Dave. Appreciate you pulling it up. Okay. So just to wrap up, reviewing the total group, the combination of the town and the Board of Education. So nothing new here, but the deficit is just above $875,000 for the year so far through April. Our gross loss ratio is 113.8, taking out the reimbursements. That net loss ratio is 107.8. 5 high claimants are above the 175. So the benchmark frequency for a group this size is 6.3 hits at 175. So while you are below benchmark, I do want to point out that those benchmark frequencies are based on a 12-month average. So you guys are, bumping right up to the benchmark, and we are not in our full plan year. So that's something that we'll definitely want to monitor. But it's likely that you guys are going to be probably right at frequency or maybe possibly above frequency once we finish out the policy period.
Dave, maybe you can see that in your reporting. Are there claimants that are starting to get really close to the threshold of 175?
Am I muted?
Nope, you're good.
Let's see. There's one, two, three. Yes, you've got at least 4 that are over 117, 5 over 117. The next one up is on this reporting, somebody had a shoulder fracture upper, it was some kind of an accident. That might be over though, but it was 162. It's not going to go over by significant amounts. It's the diverticulitis is going to continue to be there. There's a couple of cancers that could.
And we only
So-
meet periodically. Are the stop loss premiums factored into this? They're not. That's all a separate discussion, right?
No. The budget includes all fixed, even when Tori talks about loss ratio, the loss ratio includes total expenses. That's why
Okay.
100% is our target. So it's claims plus total admin expense
Yep.
and stop loss.
Thanks.
Okay. I do want to quickly, I'm going to jump ahead a little bit, but if you guys should all have this, this report, at least I know Janet has it, she can probably release it. We can release it to you guys as needed, but in the very back of this, in the appendix, I do have the detail by month, total group, and then the town and Board of Education. If you're interested in looking at the detail, there's obviously a ton of numbers on here, but I think this can have some helpful information if we need a little bit more detail month by month, and I'm more than happy to review it if you guys see that as being necessary. But that is in this presentation that we can review at a later time, or you can review on your own time if that makes sense for you. Okay, so moving on to our 2024-2025 renewal. This is our projection on our budget for our medical and dental rolled up. So this budget workup is based on just the medical plan. I do have a separate one for dental, and it's very simple. There's not nearly as much in there, but we do add that piece to the bottom. So the projected total is inclusive of the medical and dental lines of coverage combined. The town is receiving a 9% increase for the upcoming year. That would result in about a $290,000 increase in that budget. The Board of Education is receiving a 15.5, and that would be about $1.6 million increase to that budget. So overall, we're seeing the total group budget increasing about 13.9% for the upcoming plan year. So with that being said, we are running over budget this year. These increases are well above trend. So hopefully going to account for the deficit that we have currently. I do have the projection detail laid out here with some of my projection assumptions and caveats. The data is through March of 2024. So 1 month of that really, that really high month that we saw for the town is included in this projection, which I'm very happy about. We're using 7% medical trend. This is a blend of your medical and drug. And then the dental trend is 4%. As I mentioned earlier, there's no margin built into this. Excuse me. There's no margin built into this projection. So our target loss ratio is exactly 100% for the upcoming plan year as well. The credibility is a little bit different between the town and Board of Education due to the size of the groups. So because the town is so much smaller, we have that weighted 70% in the current period and 30% in the prior. Essentially, that means we're looking at 24 months of data. So we're expanding the credibility of the town's experience by expanding that experience period. The Board of Education group, though, is much larger in size, so I can feel confident putting 100% weight on our current rolling 12 period. We are not considering the prior rolling 12 period, so this is essentially a 12-month workup for the board. A really important piece here are the fixed fees. So that would be this middle section, lines 17 through 20. The admin fee actually is seeing a slight decrease compared to our current policy, so 0.8% less than current. The ISL fee was negotiated down to a 38% increase. It was initially released from the carrier at a plus 40%. We were able to negotiate that down a few points. That was a rate cap that we had, the 40%, due to the multi-year negotiations that we have with Anthem, but we were able to negotiate that down a few points to the plus 38, which we're very happy about. The ASL fee received a 5% increase. And again, overall, we're seeing a 13.9 to the total group. Can I answer any questions here about the budget or how it's worked up? Okay.
So the stop loss is year to year. The admin fees, is that part of a multi-year guarantee or is that also going year to year now?
I believe that's a
That's-
1 year. Oh, go ahead, Lisa.
I'm sorry, I tried to unmute quick, but it didn't happen as quick. To answer your question, that's typically year to year that we negotiate that on your behalf, the admin fee. And then I think, Tori, just in case questions come up about it, you had a slide on stop loss too, correct?
Yes.
Okay, that would be great.
So this is our stop loss comparison to benchmark. We do have 2 benchmark options here. So we look at both the market average and our locked-in book of business average. So with the market, we see these PPM costs for stop loss are a little bit higher. With locked-in, we were able to negotiate that down and be a little bit more aggressive through our carrier partnerships. So that's our locked-in averages are much more favorable than the market in general. Newington, however, is well below benchmark in both the market and the locked-in comparison, which is great news for you guys. That means we've been negotiating very well on your behalf over the past few years. We did see last year that Anthem did try to increase the stop loss rate pretty significantly, and their reasoning behind that was to bring you guys back up to that market average. We got in there, had some pretty intense conversations with them to negotiate that back down to a more reasonable level, and then taking chunks, smaller chunks of increases as we worked through a few years of renewal. So this year, we can see how the 23 and 24 PEPM stop loss rates are still well below market and still below locked-in benchmarks, even with that 38% increase for 2024. Dave, feel free to add some color commentary as you see fit there too.
Well, just they notified us the last year they wanted an 80% increase to get you closer to market. We market this every year, so our stop loss unit takes it out, and we get competitive bids on an annual basis. The last year and this year, all the markets came in closer to market average, and we were able to get Blue Cross to come in well below what they wanted last year, and they tried to get the full, and we negotiated a rate cap in, and they tried to get the rate cap. We got a little bit off of that. You're still below our market. You're well below the market average, and we're still below. We're below what the market believes that they should be charging for a 175 at this size. We expect this to mitigate going forward, but we don't know. It's really about Blue Cross trying to right price their numbers now. They've been underpriced, or we've been able to negotiate underpricing from them for probably 15 years.
Long time.
And they finally centralized their pricing. And they're not as flexible as far as coming off the market.
So Dave, how's our experience done compared to what they're quoting? Do you have any feel for that?
Well, it did. I mean, the biggest problem with stop loss on experience is that it's a pooled product. So
Right.
Even if you have a great loss ratio, they still say you need to get to the market rate. They obviously, insurance companies like to use it against you. We were able to offset some of that change, and as I said, it's still below both locked-in's average and market average. As far as annual loss ratio, for the most part, you've won some years and you've lost some years, which is typical on a stop loss in a stop loss pricing model.
So you're about 20 points below what market is according to Anthem now. And the ASC, is that also kind of at our market fee level right now, or has that also been negotiated for a long time and it's below market?
It's still below, the fees are still below market, and they have not, we've been able to keep them from going up anymore. We have some service issues that we've been using with them. Janet can probably fill you in more, but we're not letting them add fees.
Yeah.
But the stop loss is, it was very difficult to get any additional leverage this time through. Mostly because that market average is not just Anthem's market. We actually have bids in that are all in excess of this. We couldn't get anybody to bid it where we had any leverage with Anthem.
Dave, is that market average Connecticut or countrywide,
That is
Nationwide.
nationwide? Okay.
across all carriers also.
Yep. Then your average is for the clients you have.
These are
Yes.
locked in clients nationwide.
Okay. So it could be different just because of the demographics you have and everything and what state you're in. Okay.
It can be, you guys actually fall into most of our municipal groups fall into the higher demographic risk. It's
Okay.
older, you're older, it's an older population. So there's a mixture of population here. So it's not specific to Connecticut municipals.
Right.
That number, I believe, is a little higher than this.
I would expect it to be as
Hey,
well.
hey, Dave, I know when you and I met, I was really not an Anthem fan just based on how they're going, and you guys have done a hell of a job over the past 3 years. But if they're not giving stellar service and their fees are closely tied to what the rest of the market is, I mean, what's the allure of staying there beyond just keeping things status quo?
Well, we did a marketing, I want to say we did the marketing 2 years ago.
I think,
To,
I believe 3, I think, but we
All right,
could
so-
be right with 2.
so we did a full market check across the board on the ASO contract 3 years ago. And there was no significant savings to move to any of the other carriers in the market. Cigna's usually the go-to, and they haven't been overly aggressive, at least recently. We can do another marketing for next year, and we may. I mean, that becomes a discussion about whether or not their service levels have improved or not since the pandemic. I think some of it's better. Like I said, I defer to Janet. I know that from an employee standpoint, there is disruption anytime you do move carriers. The networks are relatively the same, but it does not eliminate union upheaval, especially for a group that's been with Anthem for so long.
And
So it
Anthem
makes
knows that.
Yeah, they do. But in fairness, their fees are competitive. I don't think we've been having significant claim problems, and the employees, for the most part, have been okay. And this is the first year where we saw significant claim growth. Last year was a little high for the town. I mean, for the board, the town was fine. The board actually was running at a little over 105% net last year. So we're just happening. I mean, I think some of it's coming out of the pandemic, which, because last year, the town was at 70% last year. They're going to swing back and forth just because of the size. The board finished the year at 105, started the year okay. The July was good, but we expect July to be good. And then we had a couple of months where they spiked, and then honestly, towards the end of this year, it just hasn't gone back down. Trend is higher, and I think coming out of the pandemic, utilization has been up. So hopefully, this is the 15% increase that we're looking at on the board side. Hopefully, that puts us much closer to the 100%, and we're within a point or two again.
I'm sorry if I'm taking up way too much time. Do you know if Anthem's got any big network renewals coming up this year, like Harvard Healthcare and that stuff? Are those cleared for a couple of years?
We have not heard anything. We've asked the question. They don't like to share that until it's an issue because they don't want to.
45 days, yeah.
Yeah, they don't like to share when their contracts are up. Sometimes they settle them quietly, but they don't tell anybody what the increase has been. But that is adding to the trend numbers.
Right. And to Dave Johnson's point before, the inflation part, that could be, I mean, your trend at 7 seemed a little bit low, but I mean, I'll trust you guys on that one.
I've been arguing with our actuaries, but I rarely argue for significantly more. Because usually we're trying to get as aggressive as we can.
Yeah, I will say that 7% is aggressive, even with our actuarial range, but it is within that target range that they provide to us.
And historically, Newington's run below trend. This is the last year and a half has been rough. But historically, we've been using it. We haven't even been, these numbers, we're compounding these trends. So your actual trend increase from a compounding standpoint was we hit it with a 16.4% increase. For actually no, 8.9 over the last 15 months.
I guess, Tim, from a town council perspective, are you guys bugged out about $2 million in 25, or is that like that?
I don't know what we can do about it. I mean, there's nothing.
Yeah.
And it's going to go up either way.
Yeah.
It's a matter of degrees, I guess.
We added the full 15.5 to the board and the full 9% to the town. And that's what's in your budget right now.
Thanks, guys.
We like giving you good news, better than the bad news. So apologize for being the bearer of bad news.
So just to close it out for follow-up, I already emailed Jenna. I was hoping she was maybe going to be able to catch up, but she's on the road. We'll get that information on the GLP-1 drugs and if there's prior authorization. My gut is saying that maybe there's a couple groups that have it, but not all, but I could be wrong. So I don't want to give you that 100%, but we will report back to Janet and Jen and Lou and Sam, and they can forward that information onto the committee.
All right. Thank you guys so much.
Thank you.
Thank you.
Thank you.
Thank you.
Everybody have a great night.
Goodbye.
And then, yeah, you guys from UBS are up.
Great.
Well, our reports are a little more uplifting.
I hope so.
Good.
Yeah.
Background's a question mark, so.
Yeah.
So thank you for having us. We thought the new committee would bring us all here to meet whoever was here today. For those that are new, it's one of you, this is a multi-generational team, okay? I'm obviously the youngest, but the market was the hardest. Ashley and David represent a different part of the generation and another generation between us, but that way we think we bring multiple ideas and different experiences to the table. Okay. So David, you want to go through the agenda?
Sure, so there's a one pager, kind of, we don't see what we plan to cover. Certainly, if there's any questions along the way. We did include a stapled handout, just giving a background of our team, who we are within UBS, just for anybody that's not familiar with us.
Just to clarify, the agenda should be City of Newington, right?
Yes, it should. Our apologies.
Sorry.
I thought it was the wrong meeting there for a minute.
This covers us Newington.
Yeah, no, I really.
Thank you. And so we typically start the meetings with a market overview. It kind of sets up the agenda for our, our discussion of portfolios. We cover the free pensions and the OPEB, their allocations of performance, and then we do have some rebalance recommendations, not for all the portfolios, but those are outlined in the back. We'll go through those once we get to those parts of the portfolio. Any questions before we get started? Go to page 3 of the book. Sure. So those on the screen should be.
Let me just see if I can pull it up. Really testing my ability, my technology ability here.
Otherwise, you could just pull out the page in order. Thank you.
They have copies, but I know that Dave on the screen does not. You just see here. What's up? All right, it's a big document, so it's just taking a little while to open for me. Yeah. Sorry, let me flip through here, see if I can do that. Sorry. I'm as good at this as I'd
Yes.
like to be.
Yep. So one more, and I'll just call out the page on the bottom right.
Probably.
Okay. And yeah, we won't go through every one of these pages, but we'll pick out a few of them. So this page here, page 3, if you have the books in front of you, is we wanted to start to talk about what's happened in the U.S. stock market so far, not just this year, but over really the past few years, and a dynamic that's taken place where a very small group of stocks, which we'll get to talk about those, but the spoiler alert, it's the big tech stocks in the U.S., have become a much larger proportion and therefore influence in the overall U.S. stock market. And so what this page is showing is that the top 10 stocks of an index that has 500 represent over 32% of the value of that index. So that's what we call very concentrated. And we'll get into sort of whether that's justified or not, but it is something to at least, take notice of.
So if you take the top 7 stocks, which last year were called man-mat stocks, which Microsoft, Apple, Amazon, Nvidia, Meta, which is Facebook, Google, Alphabet, which is Google, and Tesla, that actually makes up 40% of the S&P 500. To make it even a little different, Nvidia now with its market cap, every point it moves up is a point on the NASDAQ. So like the NASDAQ today was up a couple points, even though Nvidia was up double digits. The other stocks went down, Nvidia pulled it up. So this is a very unusual time. One of the questions we get for those of us that were investing through the end of the last century, is this going to be like the tech bubble in 1999 going to 2000? And we'd make the argument that Microsoft, Apple, Amazon, Meta, which is Facebook, and Alphabet, which is Google, actually have changed from a cyclical stock to a structural stock. And by cyclical, I mean something that's trendy is a cyclical stock. Structural means you need it to be much more productive in your business or your personal life. So if you think just about Apple 10 or 15 years ago, if I had an Apple phone or you had an Apple phone, I had Nokia and an Ericsson, I might be a little cooler or I could afford a more expensive phone. Now Apple phones have become mandatory in most of the economy. By that I mean UPS, the US military, uses Apple phones as a second phone. So we're a very highly regulated business. So we have to carry 2 phones wherever we go. So if we call this town of Newington, we have to use the Apple phone that the firm gives us. So it went from cyclical stock to structural. Most of the corporate America now uses Apple phones because of security on it. So it moved from cyclical to structural. Think about Microsoft, if the town of Newington or in your own businesses, you went to go buy software, big company, small company. In 1999, you would have had probably 10 or different firms bidding on the software. Now Microsoft is pretty much what's accepted, not just in the US for companies, but for individuals. So that went from cyclical to structural. You can make the same argument with Amazon. Amazon 10, 15 years ago, if I got one box on my steps when I got home, that was unusual. Now everybody in the neighborhood is getting boxes on their steps. Again, a whole new way to be productive is to shop online. Same thing with Facebook, which I don't particularly use, and Google is, for now, the search engine. The other thing, so all those stocks move from cyclical to structural, very different than what happened in 1999 when everybody's competing. The other thing that's changed, if you look at Microsoft, Apple, and Meta, which is Facebook, they all pay dividends now. So the dividends change the way you run your company. Google's likely to pay one, and so is Amazon at some point in here. If you think about the impact when you have a dividend, I use Mark Zuckerberg, who owns most of the shares or controls Facebook. He declared a dividend 2 quarters ago. He now collects $700 million a year in dividends every single year. Do you think he's going to run that company the same way he did in 1999 or in 2010? It's going to be very different. So the only two that I didn't mention in here is NVIDIA and Tesla. NVIDIA arguably is more of a commodity. It's a chip. In the turn of the century, Intel was the big chip company. Everybody went after their space. They got beaten. NVIDIA has a great head start, so it's not going to be 1 year or 3 years. But AMD already is announcing chips. Apple's now announcing chips for AI. So at some point, it's more of a commodity stock. And Tesla, you know, is more of a commodity stock now because the Chinese are going after them. Everybody's going after the EV market at this point. So those two stocks may behave a little differently, but we think the 5 top stocks I just went through are going to be a little bit different. Doesn't mean they're not going to go down if the market goes down, but they will do differently. Does that make sense? Okay.
Yeah, if we look on the next page, this is just a reflection of some of the things that Mark just mentioned. Obviously, there's significant capital investment going on by the the big tech names here. You could see that in 2024, the estimated amount is quite a bit higher than what we've seen in the last decade. And so a lot of this is going to the AI build out, and the expectation is that will likely continue. As they call them, hyperscaler companies, really try to build a kind of a moat around their business and to really get into an area, a theme that they think is going to be important for decades to come and probably more.
So the other thing, page 6, we talked about these top stocks. It's done for the markets, but our view is that, and what we're starting to see is that participation of the other 493 stocks is starting to broaden, and we do expect that to continue as the earnings for those other 493 stocks starts increases. And so the right hand side of this shows the blue bars are those magnificent 7 stocks, the gray is everything else, and going forward we do think that there's going to be an acceleration or a pickup. Which bodes well for diversified portfolios. I mean, this portfolio has exposure to big names through it, mainly 2 index funds, the S&P 500 and the Growth Index Fund, which has been beneficial. But there's also small cap, mid cap in the portfolio. So we do think that there's certainly a possibility for what we'll call a catch up, and it won't just always be about these 7 names.
Yeah, the interesting thing here is you look. So what this chart is saying is if you look at the gray.
Yeah, skip that one. So go back to page 5.
Okay, so if we look at page 5, this is a reflection of the broadening that we've seen the last 3 months. So the gray was the 2 months preceding the last 3 months. The blue is recently. So we started to see outperformance in some areas that have been weak for a while, such as utilities, energy, materials. Now on the right-hand side, the interesting thing is China year to date is one of the best performing markets in the world, despite all the rhetoric, despite a lot of the concerns. And one of the reasons is they've, from a valuation perspective, are very cheap relative to developed markets. But they've also kind of reversed course where they're starting to do things that are somewhat shareholder friendly. Obviously, there's greater levels of risk there, and that could change at any point. But we are starting to see other areas start to exhibit some stronger relative performance, and that's what we would typically expect. You know, if the economy is growing, you would anticipate that there's more opportunities than just 7 names. And so we could, if the economy stays strong, start to see more rotation into these areas. It's probably early on, but it's something to know.
Page 7.
Can I just make? Sure. Just a comment on page 6. I was shocked when I saw that 493 of the S&P 500 had like no growth for 2 years.
Right.
Yeah.
You know, I didn't expect that given what the economy was doing, unemployment was doing. I look at that and said, I don't know. I guess I'm more concerned about that. You guys are painting it as a pretty picture because it's growing now, but I'm looking back at it going for 2 years, they didn't have any growth in earnings.
Yeah, but the earnings are just starting to grow. So I think the
Yeah.
next page on page 7 somewhat explains it. So if you remember October through December of last year, the market, so we look at the Treasury futures market to see where interest rates are going to go. Last year from October to December, everybody said the market was not going to go up unless interest rates came down. And the market was projecting rates were going to fall 1.75% or 175 basis points. Come about March of this year, all of a sudden, and UBS was at 75 basis points. By March of this year, we still were at 75 basis points, but March, April of this year, the futures market were projecting that in March, the likelihood of a Fed rate cut was 6%, and in June was 50%, whereas before was 90 or 80, okay? Now it looks like one rate cut, and if it's gonna happen, it's gonna happen in September for 25 basis points or 20.25%. Because Fed can't do anything in October because the election is the next month, and they can't do anything until after November. So if anything is going to happen, it's going to probably happen in September if you guys are doing budgets and everything else. The thing to keep in mind where some of this is coming from, the companies now realize they can operate with a 5 to 8% cost of funds for the first time. And the way I'll put that is anybody born after 1980 has never lived through inflation. I will say, people in my group came to me and said, what's inflation like? And I said, just watch your budget from month to month in your home, and all of a sudden you're going to realize your costs are going up. That's inflation. Okay, so now they're adjusting to the fact that they can live at these rates that near zero isn't the norm. Okay, so the inflation and the rates we think are going to be cut only one more time this year. Go to page 10. Well, obviously the big question mark on exclamation point is, again, anybody who's born after 1980 has lived in a unipolar world, meaning that the United States was basically the sheriff of the world. Before that, it was Russia and other countries that we were competing with. Now we have a couple hot spots. We'll start with the Middle East. We have the Russia-Ukraine war. We have the China rivalry that's going on about Taiwan. And then internally, we also have the politics that are going on in this country. We think a lot of this is built into the marketplace unless there's a big problem. One of these things really ignites. The other surprise that's not on here that we just have heard about, we've been talking about, is the Gulf of Mexico. We don't think about that much, but it's going to be one of the strongest hurricane seasons supposedly in the Gulf of Mexico. 50% of Europe's natural gas now comes out of the Gulf of Mexico. So any dislocation there could slow down Europe's economy, which will slow down our economy. These other ones are known. Okay, but that's one now that we're going to put on the horizon also. Any questions on that?
So taking all that and saying, okay, where do we go from here? There's a page 12. Is kind of outlining through the rest of this year scenarios. And there's a lot written on this page, but just to summarize the left-hand side, is the sort of the upside, and then you have your base case, which means the most probable. You may have heard the term soft landing. You know, the economy slows down, but it doesn't go into recession, and inflation comes down as well, and the Fed starts to ease slightly. So that's sort of that base case. But if you just take the left and the middle, so 80% probability, if you could see the row at the top. 80% probability from the investment perspective that bond portfolios are either flat to slightly up throughout the rest of the year, and stocks are up, slightly up to up. So that's saying, okay, with everything we just talked about, we still think the calendar year will finish more than likely modestly positive where it is today. The 20% downside scenario on the right-hand side, that bear case, that's not a recession. that's actually what we call overheating. That's where inflation is not fully under control and starts to trend in the other direction, causing the Fed to actually increase rates from where we are today. And if that were to happen, you would see both sides, bonds and stocks, go down in value. To put numbers behind that, the next page on page 13, again, a lot of information, but if you just focus on the second row where it says the S&P 500, under these three scenarios, you're saying either 4 to 7% upside on the stocks, and that downside would be a 17%, move downward. So we're not calling for that, but it is within the realm of possibility. So to us, that's the biggest risk right now, is an overheating economy.
Last set of numbers we'll throw in, which is an observation. It's the advantage of being a little bit older, and we're working with our CIO office on the numbers I'm just going to do. The stock market and the bond market is the same as any other business, supply and demand. Less supply, higher demand, that marketplace goes up. When I started in this business, again, I'll use last century, I like saying it seems longer ago, but last century in the early 1980s, there were 9,200 individual stocks that we could pick from to invest in, okay? Discrete ones between the New York, what was on the American Stock Exchange, and the over-the-counter market. Today, there's 3,200 stocks. So there's 1/3 the number of stocks pretty much that you can invest in from the 1980s till now, okay? Why did that occur? If you think about the end of 1999, 2000, 94 through 2000, every time a merger happened or a takeover, a private company took it over, 3 more initial public offerings came out. It took the place of those stocks, okay? You think about the past 10 or 15 years, the last big offering in the United States was Facebook or Meta, okay? So there's less stocks, no new inventory pretty much coming into the marketplace. On top of that, if you were the CEO of a company in the 1980s into about 2007, and you announced to your board, you're going to do something called a buyback program, which means you go back, you have cash sitting on your balance sheet like Apple does, hundreds of billions of dollars that you had no place within the company to invest it. You're going to buy back the company stock and say, pay a bigger dividend, but they can't pay one big enough. So they have these enormous buyback programs. And that started in 2008, where there was nothing the CEOs could do or the boards. So from 2008 till now, the number of shares, so if Apple had 1 million shares for argument's sake, and they shrunk it by 36%, there'd be 640,000 shares as opposed to 1 million shares. So less shares out there. And in fact, right now the the supply of stock is down by 36% since 2008. Less stocks to buy, less number of shares to buy, more money coming into the marketplace. So what happened to the IPOs? Why aren't there not a lot of new initial public offerings? Again, when I started, there were 80 what were called leverage buyout companies. Those were companies that were taken private as leverage buyouts. In 1981, KKR, one of the big leverage buyout companies, which is now called private equity, raised $225 million for their placement to buy companies. They won't even touch a company for $225 million anymore. Okay, so right now there's 8,000 private equity companies out there, right? A lot of those would have been IPOs, but they're not. And they have a lot more power in the marketplace because the regulations, private companies don't particularly want to be public now because there's so many regulations. But those 8,000 companies, if I ask you who the top 5 employers are in the country right now, the natural answers are Walmart, Amazon, and Blackstone, which is a leveraged buyout or private equity firm, KKR, and Carlyle. Okay, so if you take all the companies those companies control, they're in the top 3 of the top 5 employers in the country. So that's partly the supply and demand of the market. When you see the market going up, in spite of the fact that rates are going up now, as opposed to going down the end of last year, we believe that's part of the reason, supply and demand. That makes sense?
Okay, so overall, you think the potential of recession's minimal before year end? We're talking, this is just before year end, right?
Yeah.
Okay.
Yeah. We're taking a cataclysmic event to make that happen.
Yeah,
To be a massive slowdown like COVID or something like that.
Yeah, we're a weird election result. I won't go there.
Somebody said it the best. We don't know.
Or a revolution as part of the election.
We don't know what's going to happen, but there's going to be a lot of heartburn.
Yeah. Any thoughts about, wasn't there just a Euro rate cut yesterday or today? I thought the European Union just voted that they were going to cut
And they were
their
talking about
Fed rate.
Yeah, I think it's
Oh, I thought they voted they were going to cut it, but which kind of surprised me. Maybe I just heard wrong.
The talk is they're gonna cut the rates, but I haven't seen them rate cut as of today.
Yeah, okay. Yeah, maybe I just saw that they were gonna cut it and just, they didn't say how much. Okay.
Let's go to the portfolio. Okay, so if we just continue, we'll start with the police pension on page 15. This is a snapshot of the more recent asset allocation. For the plan, you see it's 60% in stock. 16 of that is international, the rest is US based, and 35% or so in fixed income, remaining amount in cash. Now that cash is portfolio manager cash, yeah, most of it. There is cash that goes out on a monthly basis to pay benefits, but that's not that full amount. The following page, we just put in here just so you can see a more recent up-to-date performance number through close to the end of May. So the year-to-date column portfolio is up 5.43%. And we put that in there as a supplemental just because the rest of this report is going to be quarter end as of March.
Yeah, so not a big change from March 31st generally.
Yeah, exactly. The next page 17 shows this is as of March 31st. The value of the pension was $66,872,000. And what this page is showing is the allocation from, how much is in different types of investments. We call them asset classes, stocks, bonds, what type, international small stocks, and their target. Now the target is set in the investment policy statement, and as long as it's within the ranges, there's allowable ranges above the target and below the target. We will make a conscious, recommendation whether or not to rebalance or keep what we call an overweight or underweight. So right now, if you just focus on the right-hand column, those are the differences to the target. So the second row, fixed income, we have a 4.4% underweight to the target. So put another way, there's 35.6% fixed income compared to the target of 40%. And then you have overweights on the stock side. So there occasionally we'll make recommendations to rebalance or reduce, move around the target. But not always. We don't always do that.
It was just rebalanced in the last meeting. When was the last time it was rebalanced?
Yeah, it's 2 meetings ago, there was a rebalance where we got more conservative. And since that point, if you compare stocks to bonds, stocks have done better, right? So now there's an overweight again.
You have a range that you keep it within, right?
Correct.
According to our, I'm just mentioning that because we have new people on the committee.
Yeah, and within there's an investment policy statement, which we could distribute for new committee members that outlines the target as well as the allowable range. So if we go to page 19, let's get through here. This will show what the portfolio is made up of, not just from those asset classes, stocks, bonds, small cap, large cap, but what underlying investments are in each of those categories. So at the top, when you see large cap, those are stocks, and we have 3 different investments. One of them, MFS Value, is what we call an active manager. They are actively trying, pick stocks to within the realm of a specific index, but they're not looking to match the index. They're looking to do better than the index, or at least add value in one way or another. Maybe they take less risk, maybe they outperform. So that's an active manager, and you can see they have done that since pretty much all time periods. If you look at the 1, 3, 5, and inception period. The next 2 rows are index funds. So they're not looking to beat an index, so they're going to track the index. They're the Vanguard 500 and the Vanguard growth. And that is where we were talking about those Magnificent Seven stocks. They represent a 32% of the Vanguard 500, but they now represent, I believe, close to 60% of the Vanguard growth index. So we were aware of that. If you had your whole portfolio in those stocks, we'd be having a different conversation, but it's a proportion of the portfolio. The small cap manager, Kane Anderson, they're an active manager and they've done very, very well as far as beating the index. You just look across the board and they've done it in a very, very significant way. And then on the international side, you have two managers. One is active, which is the MFS International Value. And over time, they have added value. And then the Vanguard is an index fund. And the final.
That actually gives us.
Sure.
Yeah, and then, when we look at the fixed income managers that we have, there's three of them. All three of them are considered active managers, so we're not indexing in the fixed income space. The DSAM Core Plus portfolio is more of your traditional bond manager that tends to buy bonds with an average duration of about 6 years. Generally fairly high quality. Pretty much all of the portfolio is investment grade. So they'll invest in things like treasuries, corporate bonds, mortgages. And then we have the BlackRock Strategic Income Fund and the JP Morgan Strategic Income Fund, which have more flexibility in the types of exposures they have, both in terms of the average maturities of the bonds, but also the types of bonds that they own. And we thought it was important to incorporate them, especially when we were in a period of rising interest rates. And what you can see here is that, the two, BlackRock and JP Morgan, they've performed quite a bit better than the broad index. And so the fixed income piece of the portfolio has certainly added a lot relative to a Barclays aggregate bond index, which is what bond portfolios are typically measured against. If we put together and weight these different managers and we look at the average, as I would call it, duration, you're about 60% of what the Barclays aggregate is, which is actually higher than you used to be. We did actually extend duration when we met last September. So, one of the things that we'll be looking at, given that, we think that, the economy is going to start to cool down and there's the possibility of rate cuts, we're looking at whether it makes sense to extend duration further. We're not suggesting anything today, but these are discussions we're having behind the scenes.
I guess the last thing in terms of the master line that's on here, if you look next to it, it has a date of November 1998. We've not been working on this with the town of Newington since 1998 when we took over the plan. The data was not owned by the town at that point. We worked with the other consultants and the data that the town had, and we reconstructed the data back to 1998. The town now owns all this data, so if something happens to UBS or whatever, you can reach for the data and you have the historic data back to 1998. And that's why that's there. Any questions? Move to the OPEB. Page 26. I guess we'll go 25.
Yes.
Or the missing.
Yeah, so the way these reports are organized, they're all the same, but it started with each plan. It goes to the municipal, then it goes to the admin, then it goes to the OPEB. But the investments, by and large, are virtually exactly the same. There might be slight differences in terms of the allocations to the managers, depending on the inflows and the outflows that occur during the quarter, but generally speaking, we tend to manage these in a very similar fashion. And where there's deviations because of those flows, we will make suggestions for rebalancing.
Yeah, and we'll get there with the admin. That's where we do have a rebalancing suggestion. But for the municipal pension, you can see it's a similar allocation, 62%, 34, 35% in bonds, and the performance for the year so far, it's also similar.
Sorry, I'm down on you.
Oh, sorry. Sorry,
I heard OPEB and I started going down, sorry.
Sorry. We're on 25.
Thirties.
More pages,
Nope, too many. Nope, I don't know.
25.
It's been going back on me. I can't see the number on my screen because unfortunately it's blocked by, by the other things. So as I'm going through, sorry. That's why it's so slow.
Stop right there.
Okay.
Yeah, because, I think this is the important page, so, we're not gonna go through line by line because it's, as I said, it's the same structure. But just so, for the record, page 28 shows the March 31st performance for the initial pension, which we actually didn't go over it on the other one, but the 3 months, 5.36%, the trailing 1 year, 16.64%, which is doing very well, not just because that's a nice number, but it's beating its benchmark, and a couple of things are contributing to that. We had our overweight to stocks. Remember that the benchmark is 40%, so stocks have done better than bonds. And then we have all of our active managers, by and large, doing better than their benchmarks. So we have that Kane Anderson, we have the international MFS, the MFS value, and 2 of the 3 bond managers are outperforming the benchmark by a large margin. So there's a lot of that added value happening in the past 12 months, which we like to see.
Admin, which is on page 33. Sorry, I jumped to the OPEB, but we have them very similar in the numbers are close.
I flipped with you, sorry.
Okay.
So while you're doing that, I'll just talk
Okay.
about the differences. So investments and allocations are similar, but what's different amongst the 3 is the monthly distributions that come out. And while we have an estimate of what the monthly benefit payments are going to be, we don't know them in advance. And so, at the beginning of the fiscal year, there's a small cash reserve. And then we have sort of an automated monthly process to raise money every month to pay out benefits. The administration plan has the benefit numbers, at least in the past fiscal year, are a larger percentage of the principal than the other 2 plans. And so what's happened here, and this is actually, this page is a little deceiving. So if you look, the allocation here looks a little different because it's 60% in stocks and 6% in cash. But that's because when this was ran, it was right before a benefit payment was about to go out. So the true cash position, if we move forward to page 35, which is, we'll call it the cash reserve after a monthly benefit payment goes out, is 3.1%, or 174,000 at the end of the quarter. The other 2 plans, we didn't focus on them, but they're more like 0.5% in cash. So what's happened is if we, reserve $95,000 a month, and only 85 went out, and that happened 12 months, there's been a buildup. So what we're recommending today, and this is getting to one of the recommendations that it's on the back of the agenda, is essentially taking a portion of that cash and redistributing it back to the portfolio, to the portions that are underweight compared to the other 2 pensions, basically bringing it slightly more in line. So that recommendation is essentially a total of $120,000 in cash redeploying amongst both the stock portions and the bond portions of the portfolio, but specifically in the areas that we think will make it more in line with the other 2 points.
I think we need a motion if we discussion. That motion.
Yeah. Anyone want to make a motion to discuss the recommendation?
We need a motion to discuss the recommendations. I move that we discuss the recommendations.
Second. All right, we have a motion and a second. Floor is open. I mean, you found this long, I think that's a standard thing. to do.
Yeah, it makes sense to me to rebalance it, so it makes it more in line with the others, so.
It just makes sense.
Just so you know, this is probably, it's the smallest one of our pension funds.
Right.
It's not as volatile as the other ones. The number of members is going down significantly. I think there was like 30-something members. So it's not as volatile as you'll say something like the police, which is an open one, which we had 1 year people getting in like 6 or 7 in a year. So it is more steady, more predictable.
I mean, personally, I'm inclined to believe you guys. I feel like you definitely know more than I do about all this, so.
Yeah, I guess the only comment I would have, and I'm gonna probably vote yes, but my comment is, in our ordinance for this committee, nowhere in the functions does it say that we vote on allocation of assets. There's nothing in the ordinance about the pension. It's all about employee insurance. I've tried to change it now for 10 years, Janet, maybe.
Since I've been here,
Yeah,
7.
pre you, so.
You say
and
we're
when
doing
Ann
a
was still
job.
here. So I'm gonna vote yes with the caveat that it's not in our ordinance as one of our functions.
If it's not the orange chant, do you have any kind of idea where it's written down, who actually has that power to do that?
The council, the
Council.
ordinance, the draft of the ordinance has been, I know went by the attorney. And then after that, I'm not sure where it is right now.
You guys had an agenda setting tomorrow, right?
Yeah, we wouldn't discuss it at that point, but we have discussed this, your proposal before, and every time he brings it up, we have a new town manager, so that when
Right.
we get him to review it.
Or we're in budget season, or,
Or-
you know,
yeah,
I've been
so-
going through it for 10 years now, so
I think, I think, Jen, you should, your motion should say that we follow their recommendations. Motion is to discuss the issue, which
right,
the motion should really be to follow their recommendations. I believe.
right.
So if you would amend your motion, I would amend my second. We can vote
Okay.
on it.
Well, I was asked that we open it for discussion. but-
Yeah.
Yeah, I guess my motion would be to follow the recommendations of UBS regarding the administrative rebalance.
And I will amend my second to second your.
Works for me.
It's your admin rebalance, just so you know, not
Yep.
municipal.
Yeah. Anything else, guys? Anything else from anyone?
We need to vote for it.
Yeah, what I'm asking if you have any thoughts? No?
No.
All right, well then, all those in favor of changing the allocation to the recommendation for the admin pension, signify by saying aye.
Aye.
Aye. Any nays?
Is that a name? Yeah, that's an emergency name.
Did they vote or?
Dave did.
Yeah, he did.
Yeah.
Yep.
Yeah, I did.
I saw him
Yay,
unmute and
nay.
say
Yeah.
yes.
Okay.
All right, then we're good.
And the last one's gonna be the OPEB, that's the health insurance. Or the other benefits for the newer people, the OPEB in town of Newington, instead of it's basically a pass-through trust.
What page?
Page 34. 33, I'm sorry.
42.
No, we're going up
44.
40 something, right?
Yeah, 44, I'm sorry.
Almost had me going the other way in that one.
Stan's looking for that, so pass-through, meaning that in lieu of paying premiums to insurance company, gets paid into this trust, and through the risk management of the town and this committee, whatever's retained in there, builds up the trust over time to meet guidelines that have been set out by the government. So we've been fortunate because the risk management has been good to this point, and we've been able to accumulate a little over $11 million. Every year, Janet funds this and gives us a cash flow estimate of what needs to come out. It used to be 100% in CDs, then a little bit in bonds and CDs, and now it's a mix of stocks and bonds because we've been able to take on more risk. We've gotten growth out of the portfolio since that's occurred. Any questions on that?
Just so you know, AJ, quarterly, we get reimbursed for the claims that we pay.
Yep.
Through this. So this past quarter was a very bad quarter.
Yeah.
Yeah.
We just heard that.
Yeah, they were really bad.
These are big numbers.
Yeah, so actually, on that point, so,
What page?
sorry, the page that's up right now, we can start there. You can see quarter to date, there was a withdrawal of over $1 million. for the year, 1.4 million. And then actually, Dan, if you go back a page to 42. That is the current allocation. And at the quarter end on March 31st, the allocation was more like 61%, 1.5% in stocks, the rest in bonds. And why is it 66? Well, we didn't increase the stock allocation, but we pulled for benefit or for claim payments, we pull exclusively from the bond portfolio. So that's why there's a shift to today, which is partly why we want to recommend the rebalance. But just a little bit more color. In the beginning of your fiscal year, usually in July, there's an annual contribution to the OPEB. We take those, I mean, the strategy has changed, but the past year's strategy was we took 100% of that contribution and split it amongst the two, what we thought was the most conservative two bond funds, the JP Morgan bond fund and BlackRock. They are the shortest, and they've been the best performers. And then when the quarterly claims come in, that's where we pull from. So you have a sort of a portfolio that's got a long-term component, that's the stock piece. But it's also set up to provide liquidity without risking principal for those annual payments. That's why we kind of allocated the bonds first. Anything that's left over sort of stays in the portfolio and then gets allocated to the stock piece and grows. And it's been a strategy that's worked and it's now sort of compounding over time. But, you know, we're looking at the allocation today and, you know, we have another quarter or so to go before that annual contribution comes in. Jen, do you expect there to be another, before July, another poll?
Not before July.
Okay,
Nope,
all right.
nope. We'll go through the end of June and then I will send out to you in July. Yep.
Yeah. So really our view is now is that what's left here is the long-term piece, right? Because then the annual contribution will come in July and then, so if what's left is at 66%, we want to rebalance that back towards the target. And that's where the recommendation's coming in, which is a 5% rebalance from stocks to bonds. And that's outlined also on the back of the agenda. So we did the same thing. We basically looked at where the overweights and underweights are compared to the target and you know, made a recommendation to pull from these three stock areas, the Vanguard Growth, the S&P, and McCain Anderson, and add it to those two respective bond managers.
And Shannon, how much money did we put in the fund in July?
I can't even remember. I remember our portion. But then there's the Board of Ed portion too. So ours is, yeah. So. I want to say ours is about 800,000. And theirs is
100,000?
800.
800,000.
Yeah, and theirs is much more than that. But off the top of my head, I can't remember.
Okay. The only thing I was thinking of, would it make sense just to wait till July and sort of rebalance it then with the money that comes in, the new money that comes in?
Yeah, so the money that comes in,
Of course, that wouldn't help us by the end of the year because then we'd be back in the same place we are now, I guess, right?
And it doesn't look like the claims this quarter are going down,
Okay.
unfortunately.
Okay, we need a motion. I move that we take the recommendation of UBS to rebalance OPEB.
I'll second.
Motion and second, any discussion? Maybe? Yep. All right, well, all those in favor of taking the recommendation, say aye.
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 Any opposed? Nope. All right, we're good.
I have some other questions, just sort of general questions. You know, the Yale University, a couple people at Yale University just came out with a report that badmouthed the Connecticut pension fund and the way they did business. because of its results, mainly because of high costs, and they had very low private equity and hedge fund investments, so the return wasn't that great. And I know we don't do any private equity investments or commodities. I was surprised. I looked at Bristol, and they have like 6% private equities, 15% hedge fund, 4% commodities, and 8% private real estate that they invest in. Of course, they're 128% funded, and we're nowhere near that. But that's sort of a separate point. But do you have any thoughts about that? Is there a particular size or a particular funding level that you guys start thinking about doing some alternate investments?
Say in the past 10 to 15 years, we haven't done any private equity, any municipality. It's been underfunded.
Yeah.
Because we need the liquidity.
Right.
Okay. That's tying up capital.
Right.
If this was better funded, we'd probably be exploring it now. Part of the reason we didn't do it is we thought pricing for private equity, private credit, all those things the projections were way off because interest rates were so low. Again, a whole generation born after 1980,
Right.
projecting rates weren't going to be over 5%.
Yeah, they had
If we're gonna do it
they had
now-
free money. Yeah.
Yeah, so now the deals are probably better deals, but we'd be misplaced, in our opinion, from a fiduciary standpoint, to tie up money in something that's going to cause a lack of liquidity.
Okay.
Because the worst thing we can do is if we have another downturn like we had in 22, and we had to reach for liquidity, we'd have to go to the stock market, and it was probably the worst time to liquidate because we'd be selling out towards the bottom. And not be able to have the power coming in.
Yeah.
128% makes a lot of sense, but I dare say the returns are probably not that stellar. It's probably like the Yale study of the state of Connecticut. So returns are down on private equity and private credit in the whole area.
That's funny. The estimated returns for private equity are still pretty stupid, at least in the report that Yale did.
Yeah.
And personally, having audited some of those companies, seems like a lot of smoke and mirrors to get to the value of underlying assets, but that's my opinion.
Okay.
What's Newington funded out right now?
Huh?
What's Newington funded out right now? Or what's the level? You mentioned 148 for Bristol, I think.
Nowhere near that.
Bristol.
The police,
Okay.
based on these assets and the projection from the actuary, is probably about 70% funded. Municipal, about a little over half, 50% funded. And admin, about 45% funded.
Okay.
And OPEB, I think, is about 50. We used to be one of the highest towns, but then everybody else is caught up. So we're kind of in the middle of the pack of all the surrounding towns.
Just on that, this might be a good place to get clarification on how to move forward if there were an opportunity that we thought made sense. Let's just say in private equity. The 3 pension plans, up until this point, we've always managed them similarly. Is there if that couldn't be the case because of the differences in size, is there an issue that this committee would have with that? So what I'm saying is, historically, things are changing, but historically, private equity of any quality, as an institution, you need to have $25 million like entity value. And so if your pension, today that's 2 of the 3, but 5 years ago, that was only 1 of the 3. And so if we had done it then, would you allow one pension to kind of be invested differently than the others?
I guess we'd have to discuss that as part of the investment policy, right?
Good question.
I guess I'm not a big fan of private equity, but I just wanted to ask the question and see what your thoughts were.
And the thought process is, the police obviously is of sufficient size, won't be an issue, but typically if you're going to go 5% private equity, it probably doesn't move the needle much.
Oh, no.
So you probably want to go at least 10%. And can you tie up that much of the portfolio in illiquid investments? And so that's a discussion for a further time, I guess. But
yeah,
when you look at the dollar amounts, the minimum dollar amounts to get into some of these, deals that may not be appropriate for the for the admin and the OPEB. There might be other alternatives for those, but it may not be exactly the same as the police and the municipal. So these are things to think about, and we can certainly further the
If
conversation.
you ever want to just have a, I guess, a knowledge lesson in one of the meetings, so for the board or the committee, we can do that. And most people don't realize UBS is the largest private wealth management company in the world. You back out Blackstone and Vanguard on the index side. We also have the deepest book of private placements in private equity, private credit, and all the institutional. So we can at least hold a meeting. We were during one of the meetings that allowed 15 or 20 minutes. We give a knowledge session just on private equity and private credit. It's a lesson.
Yeah, that'd be helpful.
Anything else? All right, well, I don't have anything for you. I appreciate you guys coming out and giving us this presentation. So hopefully we could talk about the future and then get back to you with something.
You guys really give strong detail and context behind what you're talking about, and I appreciate that. And I don't want to throw Lockton under the bus, but their presentation is always just so thin. And maybe it's just because I'm kind of in that business.
Yeah.
But it's just, I would get tossed out of my ass if I went to a client with that. Just my own 2 cents. And if they're in the room still, I'm sorry, but it's month after month. It's just, they just read the news and it's like, okay, thanks. And did we get their deck beforehand?
Yes. I sent it out in one of the
really must have missed
emails.
that.
Yeah, I couldn't send out everything together. It was too big.
Yeah, I missed it because I saw 2 agendas
Friday,
and then I think this Princeton thing, but
That's right.
okay.
Yeah, I'm surprised. You say they include the large losses in there, don't they? Or is it?
Usually they used to, I
Yeah,
thought
so I
they
was
did.
surprised that that wasn't on there, but maybe that's a different time of the year.
So yeah, they did.
Huh?
They did. I was wondering what large ones.
Yeah. They did in the past, but I'm not sure. I don't know if that's like our September meeting.
Could be, but then it would be the end of their. Everything would be in by then.
Right.
Full year end, yep.
Yeah.
Again, thank you guys. Yeah.
Safe travels
Appreciate it.
back.
Thank you.
Okay. Moving on, we have remarks by committee members, so floor is open.
I guess I already just did that.
You already covered. Thank you, drive safe. All right,
I'm not a committee member, but I will tell you, it's time to go out to RFP for your agent of record. So the next meeting, we'll be doing the subcommittee again and putting this out to bid.
No. I mean, I don't think they do a poor job. I don't think they listen. And they, this committee's kind of toothless as it is, but it just.
But one of the things that is in the charter that you are very much in charge of is selecting them.
Really?
Yep.
Yeah, we have no responsibility for selecting the actuary or selecting
No.
UBS, but just to get us on
Lockton
page
is
of
your
record.
choice. Yeah, that is your choice. So
We did it 4 years ago. Did we skip one because of COVID?
2018,
2018, oh
Well,
yeah.
didn't we, because of COVID, we just decided to.
Yeah.
no, 2018. So I think it says something every 6 years on
Okay.
this one. So this is time.
Okay.
Does the town pay them or are they paid? How are they paid? Are they paid flat fee? Are they paid?
Yeah,
I
it's a
think they're
flat.
paid
hourly?
as part of the admin fees. I can't even remember.
Oh, I thought it was a flat.
I
fee.
don't pay them directly. We don't pay them directly out of our office
Okay.
now.
But your 5,500 probably would tell you what that is, though.
Yeah.
Okay.
okay, cool. Jan, I'm gonna defer to you to when the next meeting is probably gonna take
Well, you
place.
guys are talking about September.
Right.
Well, I don't know. So-
September 24?
Yes, this year. We'll do it this year. Yeah, so if fall is good for you guys, I'll put it out again and try to
And
find.
all the claims should be in by then, so it should be
Definitely.
the wrap up of the year,
Mhm.
the official year.
And are we gonna have Becky talk to us at all, or are we?
I did talk to her.
Okay,
She has your questions.
okay, yeah, but I just wondered about the rest of
Yes,
the committee.
and the
'cause
next
rest of the
meeting-
committee
The
hasn't really.
next meeting, we're gonna try to pull her in.
Okay,
I'll see you, and it might be dictated about what night she's available, because that is starting their busy season for them. Because they start doing all the
all
audit
right,
work
yeah, they
for all.
start getting the data in.
Yeah.
July 1st, yep.
So
Now what happened to the other actuary from the year before?
he's gone.
Oh,
He's
why?
not there anymore. She didn't say.
Oh.
So when is the RFP up? Is it 1/1 or is it next 7/1? When is that?
It can, we're probably gonna be 7/1, but not 7/1 of this year, it'll be 7/1 of the,
7/25, yeah, okay.
but we should start working at it, put it out, so we're ready
Because
to
it takes a
award.
long time. We interviewed, didn't we?
We interviewed,
Yeah.
we had like 12 to 15 people respond to the RFP businesses, and then we whittled it down with the committee to interview, we interviewed 3.
Right. And we did them all one night, I recall.
We did,
That was brutal.
Was it
Did a
brutal?
scorecard.
Yeah.
yes, the scorecard.
I think there was a lot of confusion about the scorecard by some members of our committee. but
Especially the third one, I was like, okay, I heard this like 3 times.
I know.
So.
Yeah, they promised you a lot of stuff of what they would do.
Okay, I'll joke with that. Still take a minute. A guy dies. So he goes to, he's gonna try out both sides of the fence. So he goes to heaven and it's, you know, what you thought and it's harps and clouds and everything's great. So, oh, this is really nice. And then hell gives their presentation and they come in and it's just phenomenal. Like everything the guy would want, just great things, great views, everything's gonna be perfect. And he deliberates, thinks about it, and he says, you know what? I think I'm gonna pick hell. So he goes to hell and undoubtedly becomes what, you know, what the book says hell is. So he reaches out to Satan and goes, what the heck's going on? This isn't anything at all what you told me about. He goes, well, then you were a prospect. Now you're a customer. It's like, that's like the one joke I remember.
That's so
like,
true though.
oh yeah.
You've been in for prospect.
Oh, that's good. All right, well, I'll entertain a motion to adjourn.
So move second.
All right,
You move this second.
we have a motion and a second. All right, we're good.
All right, we got.
Thanks, everybody. See you, Dave.
See you, Dave.
Good night, everybody. Hey, Phil, can I ask you a question about